Good afternoon, everyone. This is Kathy McBreen of the Spectrum Group. Thank you for joining us today. We're really excited to share with you some of our annual market sizing information that we have, as well as the recent results of our Investor Confidence Index. If you take a look at our agenda, the first thing that we want to do is talk about our investor indexes and what people are thinking about and feeling about investing in the next few months or the next month in particular. And then we're going to talk to you about our affluent market sizing and go a little bit more into depth into some of the demographic features, I guess I would describe it, for the different market segments that we look at on a regular basis. If anytime during this discussion you have some questions, please type them into the chat feature and we'll be happy to answer them. And all of this information will be emailed to you tomorrow, so you'll be able to have a copy of everything that we talked about today. So thank you again for joining. I'm going to turn it over to our president, George H. Walper, to discuss the monthly indexes.
Thank you, and good afternoon, everyone. As a reminder for those of you that may be joining us for the first time or in previous months, our index every month, which is released the first business day of the month, which we released this morning, tracks the attitudes and behaviors and concerns and investment intentions of America's wealthiest investors at two levels of wealth, those worth $500,000 or more and those worth $1 million or more. And it's an interesting month, if one can define interesting, as everything pretty much is flat from last month. Then that has some good news and some bad news, which we'll go into in more detail. But when we look at it compared to a year ago, we see that essentially the Millionaire Index is up a little bit, 5 points, and the Affluent, which is 500,000 and above, is up 3 points. So we would call that flat. What's interesting about the flat this month is it gives you some sense of what people were thinking about since the election in November. It gives you a sense for what they're thinking about since the market's been up. Here's the trailing 12 months at the top and the trailing now 13 years on the bottom, which we always like to suggest that it's important to look at all these numbers in the context of 1 month or 2 months or a trend. So you can see essentially since the November election, things have been trending downward a little bit or flattening out as they did this month. That's important to look at. People were extremely attitudinally changed in November. For those of you that joined us throughout all last year, we spent every month looking at how people's reaction were to all these questions and answers relative to their suggested political affiliation between Democratic, Republican, or Independent. And throughout the year, there were significant differences. But you see what happened after the election, and you see that we've been trending somewhat down, although 4 points over that many months is not a significant drop. But it does show that at some level, things are remaining somewhat the same since the election. One of the key components that we always look at in our monthly index is the subcomponent about how do people feel about their overall household outlook. Here you see that the pretty significant increase after the election, 2 months in a row, and then a couple of months drop, and then a little uptick here in the past 30 days. So this is a particular component that's remaining quite high even compared to a year ago. So again, you look at a 12-month trend of this, and this is trending quite a bit positively compared to a year ago. The subcomponents of that outlook are listed out here, the overall at the top, people's thoughts about their household income, which is kind of interesting. That's down a little bit in terms of from last month, but their outlook to the economy, their outlook for household assets are up, and their company health is down. Whether they work or the company they own. So these are essentially contribute to overall flat. It's kind of a big tie, and there's no overtime this month, unlike other sporting events. So this is one that keeps going flat. Now, perhaps the most interesting part of this month's research with our index is this rotating question we ask every 3 months: your most serious threat to your household goals. And when you look at this one page in isolation, you see the political climate being 30%. That political climate being 30% compared to these others doesn't look that high. However, what's interesting is that we've been doing this research since February 2004. This is the highest number or rating for millionaires and affluents since going back to inception, going back to 2004. Typically, this particular category is ratchets high during a national election, particularly a presidential election, but every 2 years during the House and Senate elections, those numbers are pretty high. You see the 30% does compare to 26%, which was right before the election. And that's pretty significant. So independent of what everybody's thinking about from their own political affiliation, the amazing sort of angst in Washington on both sides of the parties, Republicans, Democrats, independents, the media, etc., is causing everybody in this wealthy America to say there are threats. Now, some of those threats may not play out depending on what happens to some of these folks, and some folks are very concerned. But this being the highest since, in our measurement, 2002, is pretty significant relative to how people are thinking. So you think of that question and you think of that answer relative to everything else being flat. It's kind of interesting that everything else is flat. And it essentially says that one particular component may not necessarily change one's attitude towards what's happening in Washington. But it is one that we'll look at again in 3 to 4 months in terms of how people are feeling about this particular question.
Well, you could argue that healthcare is a political issue that affects your budget. Right?
Everything's a political issue relative to their budget. Tax issues that haven't been dealt with yet, infrastructure that's supposed to be dealt with but hasn't been dealt with. So it's just interesting that everything else is flat, but this captured what's happening in our country. The last part of our index every month is how folks say they will invest the next 12 months in different major asset classes. Equities on the left, which are trending back upward this month. Fixed income, which interestingly enough, individual bonds different than funds, but you start seeing maybe the impact of interest rates. When I say maybe, is that it takes a fair amount of time before when rising interest rates for actual make that bonds be issued under higher rates. This is essentially affecting short-term rates right now, but I'm not sure the consumer is feeling it much from their income in their bond portfolio yet, although there's optimistic. And then you see folks that say they're going to be in cash or on the sidelines, trending up a little bit the last few months. And then real estate makes sense with interest rates going up, the cost of money going up, therefore the ability to leverage is more impacted in real estate. So you start seeing some pretty interesting trends here for what people are going to invest in. So those are some of the key highlights. As Kathy said, we thought we would spend the rest of the time together talking about we call it the market size, the number of millionaire households, wealthy households, which we released all this information a week ago, or 2 weeks ago rather, to the media. And then a series of demographic analysis on each of these wealth segments. So I'll turn this over to Kathy.
Thank you, George. We've been doing this market sizing since, I would say, probably around the year 2000, and we use multiple sources to validate our market sizing, including many federal reports, other economic types of reports, other organizations' reports, and some private reports that we use to make sure that we're in sync with what we believe are the number of millionaire households in the nation. When we talk about a millionaire or define the concept of a millionaire, we include several things that others don't. So we include in our definition investable assets as well as total assets. So we are looking at things such as, a small business owner, the value of their business is included, as well as any of their retirement funds are also included in coming up with their net worth. So this is based upon net worth. Overall, this year, we found out that there were more than 10 million millionaires in total, and we break this into different subsegments. So first of all, the first subsegment is the mass affluent. Mass affluent households are those households with between $100,000 and $1 million of net worth. And as you can see, there are more than 30 million of those households in America. Clearly, this is your middle class, basically, and a very important component of our overall economy. As far as millionaires, you can see how the millionaires have trended up continually every year, with the exception of 2008 and 2009, obviously, where there was a drop due to the recession. But this year, there were 9.4 million households with between $1 million and $5 million of net worth. The ultra high net worth market are those individuals with $5 million to $25 million of net worth, And you can see that there were 1.26 million households with that amount of wealth. It's kind of tiny print here, but tomorrow when you get your hard copy, you'll be able to see it better. And as far as the 25 million plus, there are 156,000 households with more than $25 million. As many of you know, we spend most of our time every year doing reports on the mass affluent, millionaire, and ultra high net worth households by fielding studies with them every quarter and coming up with lots of in-depth information. We do the 25 million plus group once every 18 months as a standalone study because they're much harder to get on a online basis.
Now, when you think about these households, two things. Households could be one or more people in the household because a lot of folks track number of headcount millionaires. But the second thing is everybody likes, especially when I do media interviews on this data, everybody likes to say, wow, the 25 million plus grew or the millionaire grew, et cetera. The reality of it is the biggest growth in terms of new wealth entering this market are folks that have entered at the low end into mass affluent for the first time. The millionaire population that grew came from the mass affluent population last year and vice versa all the way up the food chain here. And as Kathy said, the mass affluent is, Main Street America, critical to the economy. You start looking at that at the 500,000 plus and the 750,000 plus net worth, and then the sort of 1 to 2 million of millionaire. They all tend to act similarly. And so we always like to, caution our clients that these are little artificial lines in the sand, but nonetheless, it does show the robust market opportunity in the wealth management industry.
As far as mass affluent households, we break it down a little bit more for you so you can see a little bit. It's easy to believe, and as we get into the higher wealth segments, it's easy to believe that as people get older, they get wealthier, and that's a general trend. But it's not as true of a trend today as it was when we started doing this market segmentation 15 or 16 or 17 years ago now. So you'll see as we go up market how the average net worth by age, there are a significant number of millennials who fit within this mass affluent grouping, which isn't surprising. As far as top occupations, 15% are managers, 12% are educators, 10% are in the tech business, and 9% are professionals, which we define as doctors, lawyers, accountants, and then the healthcare, dentists are also professionals. The healthcare industry. Is it this one? The average age of the mass affluent, as you can see, is 59. So the largest percentage of this segment, as well as most of the others that you will see, are baby boomers, because baby boomers are still a huge component of our overall demographics. As far as working versus retired, this segment are primarily still working, with more than half of these individuals working and only 38% retired. The household income, generally these are two-income households, and you'll see that this is a big change from when we first started tracking the wealth market in the early 2000s. Most segments today are actually two-income households. 69% of the mass affluent will use a financial advisor of some type. And when we ask them, how much do you rely upon that advisor? Does that advisor, what in your perception does that advisor do for you? And these are all self-perceived questions. These aren't questions that are bound by a legal document where the advisor may say, I do everything for them. These are the perceptions of the investor themselves. And as you can see, 46% of these mass affluent investors say they're self-directed, which they make all of their own investment decisions. So even though 69% use an advisor of some type to some degree, 46% still say they make all their own investment decisions. 30% are what we call event-driven, which means they go upon a life cycle event. I'm retiring, I'm getting a divorce, I'm getting married, I have to pay for college. Those are event-driven investors. Advisor-assisted investors are 14%, and these are people that call their advisor all the time. These are the ones that take up the most time of an advisor and help ask for their opinion, but feel like they make the decision themselves. And only 10%, especially in this segment, are advisor dependent. These are the people that really rely upon their financial advisor for everyone. This is the segment that has dropped significantly in the last 15 years, where more people used to rely upon their advisor for more things. As far as risk tolerance, as you can see, almost a quarter of the mass affluent consider themselves to be conservative, have conservative risk tolerance, but 54%, more than half, define themselves as moderate, and 21% as aggressive, and only 2% are aggressive. So let's talk about millionaires. So millionaires, again, we thought it was important for you to see that, as far as millennials are concerned, there's just as many millennials as there are baby boomers almost in this net worth category. So I think that that's important to make sure you're aware of. As far as top occupations, 17% are managers, again, 14% professionals, 11% educators, 10% information tech, and 6% healthcare. Now I want to focus for a minute on the educator, because everybody will say teachers don't get paid anything. How come they can be in the millionaire? Well, first of all, there's two things that you have to remember. First of all, these are generally two-income households. And the second important factor is that we do look at their total net worth. And a lot of those teachers have really nice defined benefit plans, which a lot of people don't have these days. So that really helps them out when they're looking at their overall net worth. The average age of a millionaire is 62, so older than the mass affluent, and a larger percentage are retired. And again, you'll see that most of these households are two-income households. When we ask about how many of them use an advisor, a larger percentage, 10% more, 79% of these millionaires will use a financial advisor, but still a large percentage, not as many as in the mass affluent, but still a large percentage, 36%, so more than a third, consider themselves to be self-directed, but you'll see those other categories, such as advisor-assisted, beginning to become larger. Similar risk tolerance, with the largest percentage being in the moderate zone. Only 16% are conservative, as opposed to the mass affluent, who are a little more conservative in their risk tolerance. Let's look at the ultra high net worth households. Again, you can see that there are a lot of Gen X and millennials in this segment, and we do, for the purposes of this segment and the 25 million plus, combine together the Gen X and millennials, because there aren't quite as many of them in the higher net worth segments. And why are these people there? 26% are professionals, 13% senior corporate execs, 11% managers, 8% educators, and then 8% entrepreneurs and business owners. So you can see that that business owner category starts to pop up even more, a lot more, as we start to go up market. The average age of this group is older at 65, and again, about half of them are retired, and only just about a third are working. But again, the two-income household is in play here. 84% of the ultra high net worth use an advisor, so you can see as wealth increases, so does the use of an advisor, and the self-directed number starts to go down a little bit, but they are very event-driven or advisor-assisted in this category. Risk tolerance, only 10% of the millionaires, or the ultra high net rather, consider themselves to be conservative. A lot more are moderate or even somewhat aggressive. So as your wealth level goes up, so does your risk tolerance increase. Average net worth by age for the 25 million plus, which is one of the most interesting groups, is interesting to look at. If you look at the Gen X and millennials, these are very wealthy young people. There are two reasons for this. The Gen X and millennials are either, one, people who have benefited from some of the Silicon Valley success in the last few years, or we're starting to see in our research the benefit of the transfer of wealth from generation to generation. So much more so than 15 years ago, we see that people will acknowledge they've inherited a substantial portion of their wealth. So that's why you start to see in this highest wealth segment, you actually still see a significant number of Gen X and millennials. 20% of the people in this 25 million plus household are professionals, 16% senior corporate execs, 16% business owners, and 9% managers, and then 8% consultants. I want to go back and talk a little bit more about these professionals, though, who are so successful. One of the things that we found for professionals, especially individuals like doctors and lawyers, is they tend to cap out at about 15 million. The ones that get to 25 million have actually taken the time to invest in businesses that are somewhat related to what their profession is. So you might see a doctor investing in some kind of medical device or some kind of medicine. So that's one of the reasons that you start to see some of these people creep into this 25 million plus household. Interestingly, the 25 million plus group is younger overall than the other segments. So this really shows us how the millennials and younger generations are starting to gather a larger percentage of the wealth in our country today. Retirement status, again, only a small percentage, 28%, the smallest number of these wealthy households are retired, 58% are still working. Again, you see the two-income households. 88% use an advisor, so similar to the ultra-high net worth, but you see a very large component, 40%, somewhere in between the millionaire and mass affluent number, that consider themselves to be self-directed. But if you take into consideration the fact that these are young people who are very successful, they probably have a lot of confidence, so their perception of how much they rely upon a financial advisor is probably, I don't know, somehow twisted, or they'll rely more upon them in the future once those advisors show them the value that they provide. Risk tolerance, not surprisingly, you can see way over on the right, 30% consider themselves to be the most aggressive and 31% aggressive. Only 5% of the wealthiest households here consider themselves to be conservative investors. So that's a really interesting thing to think about as you seek to service different segments of the population. I'll let George finish up here.
Thank you. If there are no questions, or the next minute or two, feel free to ask questions. So you probably realize that all this information is available in our monthly index. The monthly index is a subcomponent of our High Net Worth Insights newsletter, which is a great tool to tap into Spectrem's knowledge and research, first on the index, and secondly, on a particular topic from our research that we do in our various publications. A lot of our clients will utilize this newsletter and provide that to all of their advisors or anybody that touches a wealthy client. So corporate subscriptions are available. That you can see as an example, this particular month, there's a fair amount of topics about the market insights, in terms of market size, which we just said, and then different people's perceptions on different topics. We have a question. Hold on a second. We have to expand the field to read it. Go ahead and read that to me, would you?
Did your questions include the average fee or rate paid by investors at different income levels?
Kathy and I will both take that question. We have tried for 20 years to talk to consumers about how much they pay in fees, and very rarely do we find that consumers understand at all what their fees are. Given how much has been discussed in Washington and discussed especially in the 401k industry about fee transparency, et cetera, few people understand fees. We continue to want to ask those kind of questions, but the responses we get are so sort of off the wall, from I don't pay fees to I pay 10% in fees to, or I'm sorry, 10% to I'd be happy to pay no fees when the market goes down, but I would pay half of what I earn when the market goes up.
So we have lots of information, because about 2 years ago we stopped asking the exact number because people never really came up with anything that made any sense to us. But we do ask what types of fees they prefer to pay. So do they prefer to pay asset-based fees or transaction-based fees, and or if they prefer to pay like a flat annual fee. So we ask a lot of questions about fees, but to be able to tell you to say, oh, we have a really great answer as to how much they're actually paying in fees, I don't feel like we ever cracked the magic nugget to be able to say people just really don't understand what they're paying, and they say things that make absolutely no sense. So that's I guess, best answer.
The other question that's interesting, especially given the last 6 months or last year with the Department of Labor pushing the fiduciary regulations on retirement assets, is investors of all levels of wealth, rarely understand what a fiduciary is. About 80% of wealthy investors of all levels of wealth who use an advisor assume their advisor is a fiduciary. So a lot of the questions about fees and fiduciary and the Department of Labor best interests, consumers really do not understand this, and it's a frustrating factor for us trying to understand and ask questions, because the industry wants us to answer your question, but I wish we could get consumers to understand fees better.
So thank you all for listening in today. And as I mentioned, we will be emailing this presentation to you so that you get it tomorrow. And if you ever have any other questions or any other information that you need, please feel free to contact us. And I guess that's it. Thanks so much. Have a great month.